Hi, welcome to a quick video on other issues in revenue recognition. Less clear performance obligations. The first issue we're going to talk about is collectability. For a contract to exist for purposes of revenue recognition, the seller must believe it is probable that it will collect substantially all the amount that the seller is entitled to under the agreement. If the collection is deemed probable, that is greater than 50% likelihood, the sale is recorded. Now, not all amounts receivable actually do turn out to be received. We thought that was likely, but it turned out to not occur. It just happens in business. So because of that, an allowance for doubtful accounts will be established based on the percentage of outstanding receivables at the end of any period when we're getting ready to prepare financial statements. We'll see how that's done in the next module in this course. Let's talk about this though in the revenue recognition aspect of it. Fun Plastic manufactures Frisbees. On June 1, 2024, Fun Plastic made a sale to Billet's department store under terms that require Billet to pay $10,000 to Fun Plastic on June 30, 2024. The cost to manufacture the units sold was $7,000. Now, Fun Plastic does expect that 3% or so of outstanding receivables will prove uncollectible. However, it has no reason to believe that it is less than probable that this particular customer, Billet, will remit payment. And indeed, we know later that Billet did in fact pay the $10,000. Okay, so here's the accounting for that. We record the receivable for the entire $10,000 and record the revenue. Of course, transfer the inventory out, and then when payment is made, we write off the receivable. Now let's ask a couple questions. The first, how would Fun Plastic's expectation regarding uncollectible accounts affect its recognition of revenue from this sale to Billet's department store? Okay, and I sort of alluded to this when I was discussing it above. While Fun Plastic believes that 3% of its sales each period will ultimately prove uncollectible, management believes it is probable that this particular customer will pay. Thus, it records the sale in full on the day of the sale. Again, at the end of each period, the company will assess its outstanding receivables and set up a contra accounts receivable for the expected uncollectible amount of outstanding receivables. Again, you'll see the accounting for that in the next module. Now, here's a question. How would Fun Plastic treat the transaction had it believed that it is less than probable that this particular customer would be able to pay the $10,000? If it's less than probable, we can't recognize revenue. We still have the agreement, but for accounting purposes, we're not going to put the revenue in until the cash is actually received. So on June 29th, we recognize that revenue, not on June 1. If indeed we believe it's less than 50% probability we'll receive that. Okay, and then that is the accounting for collectability issues, and we will again revisit the accounting for the contra accounts receivable issue, which is related to this, in the next module. Thank you for your attention. Have a great day.